A very good evening to all our esteemed clients. A warm welcome to the sixth edition of our Alpha Managers series. My name is Shulin Kamath. I'm a part of the research and the products team of Incred Wealth, and I'll be the host for today's session. Incred Wealth manages close to 30,000 crores of assets under management. This is spread across four odd thousand clients. And we are a part of the Incred Group, a diversified financial services firm and one of the fastest growing NBFCs in India. All of you are well aware of the drawdowns that have happened in the domestic markets. In the Indian equities on the index level, we have seen close to 15 odd percent drawdowns. On the broader market, the drawdowns are even higher, close to 20 to 25 odd percent. The reasons for this is very much well known to everyone. There has been a record pull down by the FIIs in the industry, which takes their FII holdings to 13 months low. We have seen the Trump tariffs kicking in for Canada, Mexico, and China, and there have been certain counter tariff announcements as well. To add to it, there have been, concerns around the urban consumption on the domestic space, and we have seen some degree of stagnation on the macroeconomic indicators. So the question on everyone's mind right now is that have we seen the bottom on the indices, or are there more legs to the correction? Is it the right time to enter, or is it a good time to sit on the fence and observe the markets? Which are the sectors and the stocks likely going to lead the next leg of rally in the domestic equities? And if so, which are those, and which kind of sectors should be clearly avoided at this point in time? So to address all of these, Incred Wealth brings to you the sixth edition of Alpha Managers series. The topic for today is bold perspectives on market and portfolio positioning. The guest for today is Mr. Jigar Mistry, the co-founder and the fund manager of Buoyant Capital AMC. Buoyant Capital as an AMC specializes in investing through cycles and generating cross-cycle alpha. They have a unique blend of aggressive to defensive bucketing style approach, which helps them identify the market cycles and allocate capitals. So very much suited to the current market cycle. It's a pleasure to introduce the speaker for today, Mr. Jigar Mistry, the co-founder and the fund manager of Buoyant Capital AMC. Jigar has close to 2 decades of experience in equity research and investing. In his previous avatars, he had worked with institutions like HSBC Capital Markets and Kotak Institutional Equities. Prior to founding Buoyant as an AMC, Jigar was the director of research at HSBC. And in his earlier roles, he was in an advisory capacity to some of the top global funds for investing in India. So the structure of this session is the next 20 to 30 odd minutes are reserved for Jigar to take you through his views and the outlook on the market. And the next 10 to 15 odd minutes could be reserved for the Q&A session. So over to you, Jigar. Eager to hear out the thoughts from you, and request all the participants to keep on logging their questions and queries, if any, that they might have for Jigar. So over to you, Jigar.
Perfect, Shalin. Thank you as always for inviting me. I intend to run you through sort of the current debates that are on everybody's mind. Number one, sort of what do the tariffs do to several economies and how is India impacted? Two, we will look at the few things that the budget very clearly tried to tell, but we probably did not hear as strongly. Three, sort of will bring it towards the end, the view on where the sort of market is positioned. And within that, if I may, I will run you through sort of what we have done at Buoyant. And maybe I will sort of start very briefly a 5 minute sort of pitch on who we are, what we have done over the past few years. So I'm going to share my screen. Shulin, it would help if you can let me know once that is visible.
It's coming
I
up.
hope,
It's coming up.
yes.
Yeah, thanks.
Yes. So, see, Buoyant Capital was founded in June 2016. So, we are in our ninth year now. It was started by three of us, Sachin, Viral, and myself, all chartered accountants with 25 years each in equity markets. As Shulin mentioned, I was before this the director of research at HSBC and earlier with Kotak Institutional. Viral is also a CA. I am Ahmedabad alumnus, last the CIO of Nippon Life. And Sachin is also a CA, CWA, last with Nippon Asset. Today, we are almost a 64-member team. We are currently managing assets a little over $650 million. And we are now licensed to accept money from India, US, UK, and Singapore. A very unique feature for our strategy is that we run only one market cap and sector agnostic strategy. Above 5,000 crores of assets, I doubt if there are a lot of players who do this. And lastly, we are fully aligned with skin in the game. Sachin, Viral, myself, our spouses, and Buoyant Capital has only one listed equity exposure, which is Buoyant Funds. I'll not spend a lot of time on Buoyant except for this slide. That, if you look at our track record at the end of February, we have generated a little over 20.5% CAGR since inception, which puts us in the top quartile of asset managers in India over the 3, 5, 7 year period. But we don't view that as successfully. Right? For us, the objective is an endeavor to generate returns that are consistently above the benchmark, but that has to come adjusted for risks and across different market cycles. As we go through the presentation towards the end, I will run you through what we have been able to do over the past couple of months, especially when the market has been in turmoil, but even a longer track record. I'm not just going into the philosophy, etc., but my colleague Riyashri is also on the call, and people at Incred will be very happy to connect you to us should you decide to. I'll start with essentially the current predicament that we all have, which is US tariffs. So, as we all know, US officially announced that they'll put up tariffs on Mexico and Canada. It was first done on 1st of February, supposed to take effect on 4th of February, but they came and said on 3rd of February, they came and said that, look, I'll extend it by 1 month. And now they are supposed to take, they're not supposed to take, a lot of back and forth is happening. But essentially, we'll take a look at sort of what it means if these tariffs are essentially introduced. Firstly, on Mexico and China, they have put up 25% tariffs on several things and 10% tariffs initially on China on electronics, machinery, textiles, and consumer goods. And this has later been increased by another 10%. The US has actually invoked IEPA, which is to justify tariffs, citing economic security and trade deficit concerns. We spoke to a few legal scholars who said that IEPA has never been used for tariffs, and effectively there will be a lot of court challenges and injunctions, and it remains to be seen on how long this continues. But we are here to assess the impact, assuming it continues. Obviously, the reasons cited and future developments, etc., is something that we'll keep track of, and there could be potential countermeasures which we'll also keep a track of. But interesting for now is what happens should this sort of tariffs are imposed for a full year. So if we start with what happens to the Mexican and Canadian economy, clearly they are so dependent on the exports to the US that they'll most likely go into a recession. Very clearly, the GDP growth is going to suffer in a very big way. It will also result in inflations rising across the board, both for Mexico and Canada. The impact on Chinese economy is there, but that's not as meaningful, essentially. For equities, it is meaning a very clear negative, and for the currency markets, you can expect all of them to go down between 5 and 10%. And essentially, this will result in the US dollar rising by 3.5 to 4%. You remember that DXY, which is the dollar against a broad proxy, had moved up from 100 to 110, has recently cooled down to 104. So it has risen in a meaningful way. But this is not just an impact on on the countries on which this is imposed. Clearly, the US does not come out unscathed within this. If I look at our own estimates, then we are estimating that the inflation will rise anywhere between 0.3 to 0.6%, which will take the broader inflation to 2.9 to 3.2%, which is clearly way ahead of Fed sort of estimates, which might imply that the Fed will have to pause rate cuts given the rise in inflations, and essentially sort of the GDP decline will also be prominent. So clearly, it is to the benefit of nobody when you essentially deglobalize in such a short point in time. The impact on a few economies is larger. Impact on a few economies is not as large, but US also doesn't come out in a very positive light. Now, as far as India is concerned, you don't really have a very large sort of balance per se. So the trade surplus is 32 billion. But as you can see, this is not a one-way trade balance, right? There is exports and imports. And even the FDI, which was a positive 52 billion last year, we are now in the negative trajectory on a net basis. So essentially, direct impact on India is not a very meaningful number from a country standpoint. From a few sectors and a few companies who have large exposure there, obviously it would mean something. But net India reacts more to the dollar and dollar's relationship against the DXY, and we need to keep a close track on where that goes. But per se, India doesn't really have a big impact because of this. That is as far as sort of the tariffs are concerned. Uh, 2 points I wanted to highlight with regards to budget, and that is huge implications on the stocks per se. So this is the first big point, which is that there was a conspicuous shift away from capex into consumption. Now, a lot of commentators have made that point, but I think the extent to which this has happened needs to be examined in a little bit of a detail. So if you look at the FY26 markets, sorry, the 26 budget estimates, these were our estimates going into it, and these are the last year numbers. So as you see, the fiscal deficit as a percentage of GDP is slated to come down from 4.9 to 4.4%. And this is largely achieved by putting the capex or pushing the capex 1 year out. The point to note here, however, is that nobody actually expected 4.4%. All commentators and economists were at 4.5%. And the difference between those two numbers, which is roughly 50,000 crores, if you add that number to this estimates, you would have gotten to the number that the market were looking at, and you would have seen a 20% growth. Clearly them choosing to not even leave that sliver of FDI, sorry, fiscal deficit as a percentage of GDP to a number says a lot of things. Now it is not the first sort of government to do this. If you analyze a few state governments, which we have done, these are the last 12 state governments that have gone into elections prior to Delhi. You see the total capex bill, you find that at 4.5 trillion INR, 4.5 lakh crores. However, the freebie bill in most of those states have crossed 3.1 trillion INR. And in many states, that number is a very large percentage of the state level GDP. So, whereas the center is sort of giving out 1 lakh crores out of capex into consumption, the state governments have already given out a very large proportion of this, and incrementally at the economic or consumption level, the impact may not be as high as what the markets were estimating. But for capex and capex driven stock, it would have meant a meaningful thing. Point number one, clearly conspicuous move away from capex into consumption. Point number two is with regards to how the budget arithmetic is adding up. And for the first time in a decade, we think they may have overestimated revenues in a meaningful manner. We did a lot of calculations under strict assumptions to calculate whether the 1 lakh crore tax forgiven is a credible number or not. And I can run you through this, but it can take my word that essentially that's not a very sort of far out number. 1 lakh crore clearly would have been the case, which is the tax they have foregone. However, that brings into effect the other big part, which is essentially that if that is a credible number, then what it implies is something which we think will not be achieved in a hurry. So if I look at FY25 personal income tax collections, right, that number grew at something like 20%. And therefore, in FY26, when they projected a 14% growth, at the headline number, it looks like that it will be achieved without much fuss. However, we need to note that FY25 had two unique things. One, the capital gain tax increased by a meaningful 1 to 2.5 lakh crores, right? And secondly, dividends started getting taxed in the hand of individuals and not in the hands of corporates. And therefore, in FY24, Dividend was not the part of base, but in FY25 it came through, resulting into that bit of growth. And therefore 20% is overstated. And secondly, the problem with capital gain tax is that it's a derivative, right? If there is no capital gains, there will be no taxes, which means that if the market even manages to stay flat, that would mean that the capital gain tax would go down in a hurry. Now, if you assume that STT and capital gain tax falls by say about 50%, the underlying income tax is slated to grow by a whopping 35%. This is what has been built into FY26 budget estimates. And clearly, this is the number which not many people would believe can be achieved. And therefore, they miss the mark by 1.5 to 2 lakh crores here. And if they do miss the mark, then essentially you have very limited space from which this can be recouped. A lot of people will remember that RBI dividends increased dramatically, and that is now assumed to be at a very high number. So if you miss on the tax front, it would either mean that the capex gets cut further or divestment gets increased in a meaningful way, both of which are very bad for the capex, defense, railway stocks, which have been running crazily in the run up to the budget. So clearly, two very large points from the budget. One, a conspicuous move away from capex into consumption, and secondly, you have the place where the budget estimates could not is likely that it would not be met. Now, essentially, in the run up to this, sort of how do you look at it? I'm painting the sort of broad picture first, and then I'll introduce a few of these tables, which will make for a very interesting viewing. If I look at the total market in India and who owns it, that number is roughly 4.8 trillion US dollars. That is owned 50% by promoters, 10% by mutual funds, FIs own 18%, and retail owns something like 15%. So overall, retail owns a smaller proportion compared to FIIs. However, when you break this down into two parts, if you take large and mid cap, which is the top 250 companies by market cap, you find that the FII ownership is predominantly centered here. And in the retail and companies, if you look at the company number 251 on the market cap all the way down, retail owns a larger part compared to FIs here, almost three times as much. And this becomes a very interesting number when you look at the next slide, which is that if you took each and every company listed in India and multiplied it with retail ownership, I'm now excluding mutual funds, life insurance, ULIP, all of that. Then at the bottom of the market in March 2020, the total retail ownership was something like 16 lakh crores. In the run up, the post COVID, as the market has been rallying, that number has increased to a whopping 67 lakh crores. Obviously, this has impact of some new inflows, but if you look at the RBI and MOSPI data, that's not a meaningful number. So net retail as a cohort has generated a wealth in excess of 50 lakh crores. How large is, to listen 50 lakh crore looks like a big number, but how large really is 50 lakh crores? If you put it in context with respect to India savings, then whatever India saves in real estate, gold, silver, equity market, debt mutual fund, and bank deposit, minus the loans taken to fund those. So savings at the net level last year was something like 14 lakh crores. So there are 50 crore Indians who save something like 14 lakh crores. There were 2 crore active demat account holders on average operating in that time who have generated 50 lakh crores in wealth. Where have they generated this wealth from? Essentially in the small and the micro cap space. And many of them started believing that there is this new casino in town. You have to keep buying the same shares, keep buying the same small cap mutual fund, and that will keep generating the wealth for you. And that is part of the reason why these markets have completely toppled over. What has happened? If you look at the number of folios, the green line is the small cap line. The number of folios have gone up from 5 million to 22 million. So they've almost quintupled in under 5 years. And the AUM in these schemes has gone up from 50,000 crore to 3.2 lakh crores. The large cap AUM is 3.8 lakh crores. So there is a similar AUM between large and small cap. Whereas if you look at the market cap, the large cap market cap is more than three times of the small and micro cap market cap combined. So a lot of money kept flowing into the same small cap mutual fund, the same small cap stock, which resulted in the EPS rising at a much slower pace, and the market started increasing because of flow effect. How long did it go? If you take a 5 year rolling and a 10-year rolling period of the large cap index to start with, you will find that the EPS growth and the share price growth is really well aligned. You see a 10-year return that's well aligned as well. If you take a small cap index, you will see these numbers aligning fairly well. Or if you take even individual stocks with a long enough trading history, you will always see that the share price growth and the EPS growth is always similar. However, at the peak of the market, the total embedded value, so the market cap growth in the small cap at the peak of the value was 36% higher than the earnings growth. Now, when this happens because of flow, if in a 5 year period your EPS and share price growth fully aligns, then you must be able to argue that your EPS will grow materially higher. But EPS growth was not increasing. If anything, it was reducing. And therefore, stood to reason that the share prices will correct dramatically. What would the likely outcome be? It could have happened that the market would have become completely flat and the EPS would have risen 2 years to correct this anomaly. Or the market could have fallen 15% in a year, the earnings would have risen 15%, and that way this would have been corrected. Or the third option, which actually happened, was that the market would crash something like 27 to 30%, and the entire anomaly would have been resolved. As you look at this data on 28th February and look at the CAGR numbers, then you see that the large cap over a 3 year period is now growing at a number which is lower than the EPS growth, and the small cap index is basically growing higher but only marginally. So, large extent, all the excesses that were built up because of the flow issues have been resolved to a significantly decent extent. However, one needs to realize that whenever the rally happens next in the markets, and it will not be a one-way rally, you will find that the stocks that have led the rally this time around will not be the ones that would be driving the rally next year. Essentially, how all sort of in the next 5 minutes, I'll run you through sort of how are we positioned. Now, Shulin did mention that we run a strategy where there are on occasions we are aggressive. When we are aggressive, the small micro cap and these what we call satellite companies become a very large proportion of what we do. And then when we become defensive, the proportion changes dramatically. So if you look at this chart, for example, the green bar is the small and mid cap bar, the gray bar is the large cap bar. So post COVID, when everybody was busy buying IT, pharma, and FMCG, we started increasing our exposure in small and mid caps, and we were very well positioned for the U-turn that was about to happen. By September 21, we started writing that essentially you will now see globally coordinated interest rate hikes. So we started reducing this exposure at the time when markets was going really great. And by the time sort of Russia-Ukraine happened, as you see, we were very well positioned to take the fall, the hit on account of the market fall, and we ended the year on a positive note, even in calendar year 2022. Post 22, the Indian markets went into a shell of its own that allowed us the opportunity to invest heavily into small and mid caps again. Our large cap exposure came down dramatically. And since the last year and a half, we have all seen how well these small caps have rallied. We were already basically on our way down here. And by the time we are ending February, large cap is a very large proportion compared to the small and mid cap that we have seen. And even the small and mid caps that we have essentially are the ones where the liquidity is very high and the embedded value is fairly low. Now, all of this, how does that translate into numbers? Because I saw a couple of questions where people were asking how it translates into numbers. So I'll briefly run you through sort of point in time returns first. Point in time, you will see that over the past 1 month, We have fallen lesser than the market, as you are seeing several websites, and Shulin does a fabulous compilation. You will see that many of the funds are down double digits in a very meaningful way. The small cap index was down something like 13.8%. Even in the 6 month period, we have been able to protect the downside very well because we were defensive. But over a 1 year, 2 year, 3 year, 5 year, and since inception, you will see that we have generated an alpha which is higher than the market across most of these time frames. And this has been achieved by having exposure in the beta which is less than one time, and standard deviation of the index of the portfolios, pardon me, being lower than the index when we want it to be, but post COVID, when we were aggressive, we had a much higher proportion there. Another way to look at this is basically, looking at average returns. Now, this is important because over the past sort of 1 year until December, everybody had made so much returns that rolling returns had lost its relevance. But as you see, when you compare, say, a 1, 3, 5, and 7 year rolling return, you will see that on average, say, over 1 year, we make 10 percentage points higher return compared to the benchmark, and our outperformance rate is industry leading 58%, which increases significantly when you do a 3 year rolling return, and then which increases even more on a 5 year rolling return. On a 5 year rolling return, we are a little over 5 percentage points alpha over and above the index. The lowest returns we have made is is similar to the lowest returns that the index has generated. And as I said, we are 95% over and we're 95% empirical outperformance probability. And when you do a 7 year rolling return, you will find obviously that our alpha is way higher. The lowest return we have made is higher than the lowest return that the index has made, and sort of we are 100% of the times outperforming. So the longer the investors have stayed with us, the higher has been the empirical probability of generating a superior performance. I'll just end it sort of by saying how, in summary, what sort of Buoyant is. So if you look at sort of just the output, we are reasonably up there in the alternative food chain at roughly 21% CAGR. But the beauty of this strategy comes alive once you layer it with risk and consistency. More importantly, we follow a strategy which is entirely different vis-a-vis others, and we execute it via one strategy. Now, frankly, it is easier to run three strategies than it is to run one strategy. You can have a large cap fund, a small cap fund, couple of sector funds, and that way, it's a great marketing tactic. You can showcase one or the other depending on where the market is. But we realize that most of our investors are either busy running a business or taking care of a job, and they don't really have the time or the wherewithal to essentially know what cycle we are in. So we run only one strategy, which is truly market cap and sector agnostic. There are times which I have shown we are 65% large caps, there are times when we are 65% small and mid cap, finance, pharma, FMCG, whatever makes sense. This is the only strategy we run. But we back it up all the way. As I said, all of our own investments in the listed equity space, Sachin, Viral, myself, our spouses, and Buoyant Capital as an entity, has only one listed equity exposure, which is Buoyant Funds. So that's all that I wanted to present. Shulin, I hope we are in time, and I'm happy to take questions if there are any.
Yeah, perfectly timed, Jigar. Thanks a lot for the detailing and the lucid and insightful data points that you have brought up. Quite a lot of questions. Some of them are very interesting ones. So let's start one by one. The first question that's been asked is related to the past and the expected returns of the fund, and the relevant strategies that you adopt to outperform the underlying benchmarks.
Sorry. Uh, a past return and relevant strategies for EMS besides universe.
Yeah.
See, past numbers, I think the gentleman asked the question as soon as the sort of webinar started, Shulin. So I think the past number is more or less clarified. The expected number, as you all know, SEBI sort of refrains us from giving out any expected return expectations. But it is fair to assume and think of it in a scientific fashion, something like this, that let's say if your Real GDP in India keeps growing at 6.5, 7%. Inflation is 3.5 to 4%, then you're talking about say 10, 11% sort of index growth, sorry, nominal GDP growth. Now, nominal GDP includes, your agri. The representation of agri in the market is not very large. And therefore, if you remove agri, non-agri GDP is growing at say 11, 12%, which is what, as you show in that table, is the sort of growth in the earnings of the companies on a sustainable basis. As we also saw, the EPS and share price growth essentially always aligns, and therefore 12 odd percent is what the market has grown. I don't have enough basis to argue that the EPS growth in the next 10 years will be materially higher than the EPS growth of the last 10 years, and therefore I think similar numbers will likely continue. And as far as Buoyant is concerned, historically, we have outperformed, as I showed, on a 5 year rolling return basis by a little over 5%. So I think most people can then do the math on how basically to think about this.
Yeah, sure. Thanks, Jigar. Jigar, since you touched upon this, defensive and aggressive bucketing style of investing that's very popular with Buoyant as an AMC, right? Currently, could you throw some light upon how's the positioning in the portfolio and what's the underlying hypothesis behind this?
Uh, Partly, I did run through that, Shulin, when I detailed sort of how we are positioned. But for the fullness of clarity here, in April, May 2023, there were sort of a lot of apprehension because the budget that year had completely incentivized, debt investing, or rather, the debt benefits was being taken away, and the life insurance benefits were also being taken away. So a lot of investors, the incremental savings were not into equities, and they started investing heavily into debt and life insurance. By then, obviously ours is as much a bottom-up approach as much as it is a top-down one, and we found a lot of businesses offered very attractive opportunities. Starting sort of March 2024, the stock prices started rising very heavily, and by some September 2024, you saw that the number of stocks that had doubled from the May 2023 number was something like 850 shares. In comparison, at the peak of the market in the GFC, the number of companies that had more than doubled were only 156. So clearly, this was a much wider sort of rally and boom that happened. And we found that many of the businesses that even we were holding were, expecting return estimates which were far higher than what we were prepared to pay. So continuously, we are reducing the exposure in small caps. Less than 3% of our market cap today is invested in companies with less than 10,000 crore in market cap. So that exposure has been brought down to the bare minimum, and that is the way in which we have been able to protect the sort of downside in these choppy waters. So I think that is how we are positioned today. Incrementally, as I showed, by 28th February, the markets appear that they are a little more aligned compared to their earnings growth. But seldom does it happen that the market, falls like a rock without an incident, and then that rallies in a V-shaped fashion. People always remember that look, in COVID it fell, and then over the next few months it rallied to a level higher than the pre-COVID level. But that was an event-specific thing. People overestimated that event, and then the rally happened. This time around, you are coming from an expensive base into a much more neutral base, and therefore I don't expect the rally to be a V-shaped rally. It will be a scenario where one will still need to be very, very careful on stock selection and sector selection. And that is the way in which I think the entire transition will likely happen.
Sure, sure. Jigar, since you touched upon some of the sectors that you typically like during this cycle, right? So this is a pertinent question related to the views on the some of the sectors like paper, manufacturing companies, media, capital market, and textiles. Some of them are also having an exposure towards the Trump tariffs, and that's been an ongoing topic in the market, right? So, what's your views on that space?
So specifically, the sectors, Shulin, that we like are sort of banking, financials, healthcare, consumption at the margin, and materials, especially cement. Paper manufacturing or textile companies is very dependent. Like for example, I'll give you textiles is very dependent on you in on India signing the MFN agreement with Europe, right? Pakistan and Bangladesh have a very high margin or a very low taxation that gets applied to them, and therefore it's unlikely that Indian textile manufacturers will be able to grow unless that agreement is signed, and in its absence, we don't really think there is a very material number to talk about. Capital market on a trajectory wise is upward sloping, but I think they're paying a lot for it already and may not sort of run away in the rally. Paper and media are per se not very large sectors. Paper, I don't really have a view. Media is on headlines a little inexpensive, but it's been inexpensive for a while, and these companies have not really shown a resilience where their earnings growth have completely happened in a trajectorial manner. So clearly, on the sectors that Mr. Sharma mentioned, these are our broad views. But I think the ones that we find the most value is BFSI, healthcare, staples, and materials.
Sure. This is a interesting question, Jigar, because you are against this buy and hold strategy and more aligned towards active style of management, right? So the gentleman has asked you to clarify on the exit strategy and the thesis based approach in detail.
Right. So the exit, you see, fundamentally, we don't believe that a good company is always a great investment. And by extension, we also don't believe that companies that we own are a great investment at any price. In that padlock, what we do is we essentially do a lot of research, but boil it all down to say five reasons why we are buying this name and three risks. If the five reasons play out and the three risks don't play out, and the stock moves above the level which we are comfortable with, then we are very happy to sell that business. So an effective sort of transaction. Secondly, no matter how much research you do, but eventually there will come a time where the risks that you didn't think of will materialize. At which point, if our thesis is broken because of a risk that we thought could happen but manifests in a much higher stance or materializes that we didn't think of, in which scenario, if the thesis is broken, then we are very happy to exit. In a scenario where company keeps delivering on what we think it should deliver, and the stock market is not very appreciative of that, then we are very happy to keep holding that.
Sure. So the next question, Jigar, is pertinent to the taxation angle in the PMS strategies. What's the average churn on an annualized basis in this PMS?
Uh, I would say we are on average between 30. So this year we are between 35 and 40%. On average, we have been around 25 to 30% because in this fiscal year, you saw a lot of businesses getting repriced so fast that the businesses we thought we are owning for 3 years, the sort of thesis played out much sooner. However, the bigger point to mention clearly is that, you know, people focus a lot more on taxes, but often sort of tend to forget the fact that a business can fall 25 to 30% in no time if it is overvalued. In our estimate, if you ask us, you want to compare sort of a post-tax return of say mutual fund versus Buoyant, then I think on a rolling return basis, anywhere between 50 to 60 basis points is the cost that we think we incur in excess to mutual funds. And you can reduce that number from our returns and compare it on a rolling return basis.
Sure.
Swaraj is asking, has the market bottomed out, sir? Basavaraji, it would be great if I knew that. But yes, the risk reward ratio has become sort of a lot more favorable.
Sure. Anything that you are suggesting to the clients related to the top ups, or whether it's the right time to go for lump sum or staggered kind of investment? This is a very popular question nowadays. Jigar, you know that.
Yeah, Shailen. So yes, for the first time in 2 years, we reached out to our investors and said, if you're looking to sort of if you're sitting on a war chest, we are very happy to sort of take top ups now. This is the first time in sort of a year and a half or slightly more that we actively reached out to them and said, now is a good time to invest. So very clearly, see, it might not bottom right away, and we keep saying that like we didn't really know the sort of top fully, but becoming defensive allowed us to protect the downside in a way that even over a year basis, we still managed to generate a positive return despite us being defensive. The same way will happen on the downside. The stock selection, sector selection will be very different. But yes, time to increase investments in a PMS has come through.
Okay. So the next one is in relation to the underweight sectors in your portfolio, Jigar. While I believe you won't be able to comment much on the stock level, at the sector level, would you be able to highlight the underweight positions?
So real estate is one sector which we think has benefited a lot with respect to the wealth effect. And that is one sector which is showing clear signs of questions being raised. And therefore, one sector we will not be very happy with. Consumer staples as well, right? The consumer staple basket is reasonably large. And therefore, to that extent, it may not sort of rally as much as as much as people think it might. So those two sectors are the ones which I think. And third, if I have to stretch, then maybe IT as well. People have been buying IT as a hedge against falling rupee, but I think the core business is not growing as fast as people thought it would.
And as far as the IT is concerned, does the Trump administration angle got to do anything with the view?
No, I think, see, they will be pragmatic. It looks like the new president talks a lot of gibberish, but the fact is that essentially you will have someone who has a lot of data at their disposal and he's not talking out of thin air. So, it looks like a very haphazard approach, but he's essentially somebody who has made a lot of deals. And you can assume that he's using tariffs as a measure to get the people on the dealing table. So we shouldn't really assume that these tariff measures would last the full year. But even if it does that, I don't think will be sort of unsystematically approached.
Sure. One last question, maybe, Jigar, and that would be the end of the Q&A session. A lot of chatter around the market at the positioning, the segmental positioning in the portfolios, right? So, with the kind of correction we have seen in the broader market and the benchmarks, some of that froth, which was prevalent maybe 3, 4 months ago, has gone off from the market, right? So, at this point in time, what's the kind of segmental positioning that you have in the PMS strategy?
As in what's, sorry,
The
Shulin.
the large the large mid and small cap
Yes,
allocations,
so
and
we have
then maybe talking a bit about small cap allocations in the portfolio.
right. So 54% large caps, 20% mid caps. The balance is small caps. Even the small caps that we had were sort of the ones which have no embedded value per se. So a lot of them, in fact, the small caps that we have in this period is less than 5% away from their all-time. A lot of small caps did well because of the flow issue and everybody congregated around the same stock, right? Because so much was flowing through WhatsApp and Telegram channels that because India is doing capex or defense spending, then let's all sort of get there. The ones that we had is the lesser known, say, pharma company, lesser known IT company, and they didn't rally as much, frankly, in the previous cycle, and because of that, they haven't fallen as much. So small cap for us is a pretty much sort of a bottom up idea rather than a top down sectoral idea. But even that number it tends to be much higher in the last cycle. For example, in May 23, we just showed how that number was closer to 63%, which is now the small caps are now less than 25%, to be honest.
Yeah. Thank you, Jigar. That was the end of the Q&A, session for you guys. Appreciate the kind of views, the granularity, and the insightful pieces that you shared with all our esteemed clients. I'm sure the clients will have a lot of takeaways from the session. So thanks a lot for that, Jigar. Thank you, everyone. Thanks a lot, clients, for attending the session. We will keep coming up with all new editions of the Alpha Manager series. Do attend these sessions. These are insightful pieces from Incred Wealth for all of you guys. Thank you. That concludes the session. Thanks, Jigar. Thanks, everyone. You may please log out. Thank you.
Thank you.